Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is July 4th, 2025. Happy Independence Day to our US listeners. For those of us elsewhere, it's a regular work day, but we are coming into the summer, so the spirits are high. Here we are sharing the slides for our YouTube listeners. So I'm delighted to be joined today by Stephen Isaacs. Stephen, I've known for many years. He is a prominent market commentator, the owner and chair of George Harrison Limited. He features on CNBC and Bloomberg, does a lot of Asian investing, and previously worked as a director of fixed income trading. Welcome, Stephen. Thanks for joining me today.
It's great to be here. July the 4th is not a holiday that us Brits like to remember, but I will wish you in the spirit happy July 4th.
Very good, very good. Well, I've always enjoyed our provocative debates that we've held, so delighted to welcome you here and cycle through some of our usual issues. So our regular listeners will know that we always cycle through inflation, interest rates, geopolitics, equity markets, and other asset classes. And I know you'll have a view on all of those. So I want to get straight into it. But just in terms of some of the subtopics that we're going to run through today, one is the idea that the Fed in the US may now be a lame duck Fed, as the president has already indicated that he has a successor in mind and has made no quiet thing of his disdain for the current policies of the US Fed around being slow to lower rates. We've had in the last 24 hours confirmation of the big beautiful bill passing. Equity markets have continued to be resilient this week. And in the UK, where we both are, there's been a touch of PTSD this week for a loss of confidence in the UK in its fiscal markets. And of course, we'll talk about portfolio implications. So let's kick off talking about the economy, Stephen. So I know that you do look at the economy in the US just as carefully as you look at the economy elsewhere, and especially the UK. We've gone from an interesting juxtaposition of last week, the Fed claiming that the pace of job creation was a concern. And then we had two conflicting jobs numbers coming out of the US this week, one that's suggesting had been a loss. And then recently adding 147,000 jobs, just more recently coming out of the Bureau of Labor Statistics. So this would point to a certain resilience in the US economy. That is why perhaps rates have remained on hold. What's your take on the resilience of the US economy, and why is it so stubbornly resilient, do you think, at this time?
Well, first of all, I'd like to say I'm glad you focused on the Fed, because monetary policy is the most important thing that we should always actually discuss first. And I'd like to jump into that one, perhaps come back to the strength of the economy in a minute. I think it's a reasonable concern for the administration to question whether Powell and the Fed have been essentially behind the curve on more than one occasion. They certainly were behind the curve when inflation ripped higher, a couple of years ago. They were very slow to notice the issue. We had team transitory, as you pointed out in one of your slides, and it took them quite a while to get going with rate hikes. In the last 12 months, we've had essentially some adjustment in interest rates, but interest rates are still standing at close to 30-year highs. And now focusing on the strength of the economy, are those interest rates appropriate? And where is the fiscal pressure leading? So are they appropriate? I think they are on the high side. I think the economy is bumbling along at the 2.5% level with moderate job creation. One should look at more than one number, and your chart there is very helpful. You can see there that job creation has perhaps slowed down a little bit, but still is coming through. And if you look at other data, retail sales, GDP, etc., one can feel reasonably confident going into the second half of this year that there are no obvious alarm bells to suggest that we're heading for a recession or any other reasons for the Fed or all of us to panic. But inflation is essentially positive. Interest rates are essentially positive. They're probably a couple of percentage points above core inflation, which is restrictive, which is historically restrictive. So I don't think commentators, the president among them, are necessarily wrong in questioning why interest rates have only been very gradually brought down from historic highs. Maybe it's the politics. So perhaps let's move on to your comment about lame duck Fed. Powell's term runs out in May next year, less than a year from now. And it is certainly appropriate for any administration to be casting around for what is probably the key appointment for any government these days. And then we should ask ourselves, what kind of person is Trump going to pick? It is really much in his gift. The president always nominates the Fed officials, including the Fed chair. It then goes to the Senate Banking Committee to approve before it goes to the full Senate, bearing in mind Republicans have a small but genuine majority. They should be able to get through, most candidates. So our question is Trump going to appoint a kind of Arthur Burns? Arthur Burns was Nixon's appointment in the early 70s, who was a real dove, who really kind of allowed inflation to get out of control in the early 70s at the behest of the president, who wanted easy money. All politicians want easy money for the short-term fillip, for confidence, etc. Is Trump going to go down that route, or is he just looking for somebody who's a bit more skilled, a bit more proficient, perhaps, than Powell? That's an open question. I don't know the answer to that. I'm going to slightly hedge my bets. I am not convinced that I don't see why Trump would want to let the economy rip and inflation to really become a problem, perhaps in the second part of his term. I mean, he isn't going to face the electorate again, despite one or two blandishments on X. I think he understands that the Constitution is pretty clear that he cannot stand again. So if you're looking at your legacy, as Trump must be doing now, he's certainly packing the presidential library with some quite nice new shiny toys, courtesy of Qatar and others. I'm just not convinced that Trump will pick an Arthur Burns type figure. There is talk about Scott Bessent. I think he's probably the leading candidate now. Scott Bessent has been able to handle Trump, handle the markets, handle the very, very complicated trade issues pretty adroitly. And I would say he's got to be close to a favorite. And if he becomes Fed chair, sure, rates will probably come down next year anyway, but I don't think we're necessarily going to get a complete debasement of money.
Yeah. Well, really interesting observation there. And I do have a slide a little bit later which discusses this 1% solution, because we know that the president has, I think he provided a graphic suggesting quite clearly where he thought the Fed rate should be, which is 1%. But if you look at this chart here, again from Bloomberg, it shows that the Fed rate has never hit 1% with inflation this high. So remember, we still have inflation north of 2%. The Fed is very data dependent. And I would argue that with such a robust economy in terms of job creation, certainly economic activity, the stock market reaching new highs, what would be the need to stimulate the economy at this juncture with a rate cut, given that it's a different story perhaps in Europe and the US and the UK, which do not have that tailwind of a resilient economy? There is a real need to really avoid the stagflationary outcome there, at least the stagnation. So I can see it's kind of a different story, but I think this is interesting that there's 1% level.
I think 3%, you can see we've got, the chart is actually very helpful. You can see, first of all, there's a lot of lags. Monetary policy tends to lag. And secondly, that real rates are quite high, but I think 3% funds rate, next year, possibly even 2.5 running into the back end of 26 into 27. That is probably very reasonable. If Scott Bessent or a kind of sensible Fed chair with a committee, by the way, the Fed chair doesn't have complete authority. He has to carry the committee. I think that's reasonable. I think that's where markets are seeing rates. Are we going to get 1% rates, which would be pretty unprecedented, as you point out, and would be pretty serious debasement? I'm not even sure Trump wants it. I mean, we know that Trump's negotiating style is to call for something pretty extreme and then kind of hope that things settle down somewhere in the middle. So I think that's a little bit sort of his style. Interest rates are going to come down. back end of this year, going into 26, and in all of 26, they are probably too high given the trajectory of inflation, and oil prices are under control. The tariff situation seems to be under control largely, so there's no sort of external shock that's going to see inflation dramatically turn around. That I think is the core scenario, and I think that's probably what the markets are looking
Yeah.
for now, which is one of the reasons why we're where we are at the moment.
And let's get to the indicators. And I should say to our listeners that you were one of the few that very correctly forecast President Trump's victory in 2016. I think again in 2024, you have been on the money at every point. So that gives me that gives, I think, your forecast quite a bit of credibility here. But one of the interesting juxtapositions we're seeing is I suppose this cognitive dissonance perhaps between some of the economic indicators, the hard data, as they say, being strong. We talked about jobs, we talked about even GDP growth. It has come down, but it has still been strong. And then the consumer sentiment faltering. And we can see that there has been basically a swift deceleration, some of these charts show, in the growth of outlays and services. And when we look, say, in May, where spending really has taken a hit, it has been on motor vehicles and parts. Some of the durable goods have taken a hit. There's been increased spending in, say, food, accommodation. It is coinciding perhaps with the summer travel season, clothing, footwear. But overall, the consumer sentiment-wise has also been not quite matching the hard data. And then we have quite common headlines coming from not only the AI companies themselves, but also the big tech. And even we've seen some of the motor companies come out with these kind of headlines around the quiet part out loud. AI will wipe out jobs. And we're seeing this, really come for the white collar sector most of all. So this kind of drumbeat, which is not exactly upbeat, is there in the background and does seem to be creating challenges for the consumer. And we can see again that the consumer expenditures have been weak ahead of some of the tariff excitement that we saw around Liberation Day. So what do you make of that juxtaposition? Do you think that the consumer is the canary in the coal mine here, that the economic data maybe is lagging and is not actually translating some of those the weaknesses in the field?
I think some of this is actually kind of just a reaction to the big sell-off in the stock market and Independence Day and the news and the media cycle, which was understandable. So the data that you showed there was May, which is kind of all immediately reacting to the Independence Day furore. I think that the wealth effect, is underestimated. Stock market back to all-time highs, through all-time highs this week. There was a negative wealth effect in Q1 running into May, June. And secondly, there was also a negative effect to what was going on in Washington. In other words, the attempt, quite strenuous attempt by Elon Musk and Doge to kind of tackle some of the fiscal issues that we all know are a huge problem. So that was creating a bit of a blowback, particularly amongst government workers, that there we are, we had a new committee, outsiders, who came in supposedly with a mandate to really kind of hack away at government spending, putting a lot of people on notice they might lose their jobs. The kind of whole negative aura, that was one of the reasons why the market took a tumble in Q1, was that there was a feeling that if federal expenditure was going to be reined in, and the denominator effect that would have on the whole economy, that was going to be a negative effect. Well, hey presto, Elon Musk literally left Washington with a black eye. He literally had a black eye. Joke, but it's true. And his efforts were essentially completely superseded by the political cycle. Whether or not it was fear of the midterms, whether or not it was actually always Trump's agenda with the beautiful bill to actually kind of cement a completely different path of fiscal expenditure, which, needless to say, not being reined in, it's the opposite, then that was one of the drags that could have impacted upon the economy. And now it's the other way. We've got the taps going to be wide open. We've got a whole load of new tax cuts. We've got tax relief on tips. We've got tax relief overtime. We've got, all sorts of new tax relief on local property taxes, assault exemptions, you name it. So there is a fiscal stimulus essentially coming. So I think, we had a markets were overbought. The wealth effect had perhaps gone too far in Q1, early parts of Q2. Now we're going the other way. So if you look at second half of 2025, we have some quite big positives. Wealth effect, we have the prospect of lower interest rates and probably the actual reality of lower interest rates. We've got, kind of subdued gasoline prices. Gasoline prices are very, very important in America. One of the key drivers of the amount of money people have at the end of the week in their pocket is the price of gas when they fill up their cars. People drive a lot more in the US. Transport goes further distances. So the cost, the part of inflation in gas price is something I watch very, very closely. And that's now quite a big positive. Okay, we had a little blip over the, Iran 12-day war, as Trump has called it, but it was only a blip. Gas prices are back, where they were. That's another positive. So I think it's all pretty positive running into 25. The markets have corrected. Some of that froth has come out of where we were in Jan, Feb. And now, to be perfectly frank, I think we're going to push on. We should come back to that later on. But I think the economy is going to hold in and possibly pick up running into the back end of this year into 26.
And that's fascinating. And I did bring up a little bit early the equity market chart as you were talking about it, because yes, they have hit new highs. I had a look yesterday at the first half numbers, when all was said and done. And, generally there's a remarkable synchronicity. Most markets up about 7% in the UK, in the US, European markets even similar, despite having run ahead. The German markets are standing alone as being up in serious double digits. Most of that perhaps due to the industrial and defense spending. I just wanted to touch on one thing before going back to equity markets was around equity market volatility, in line with your suggestion that some of this furore is now in the rear view mirror. Equity volatility is lower than it was before Liberation Day. It has almost incontrovertibly been tariff uncertainty that has driven equity volatility. It has not been concern around the budget deficit. It has not been concern around geopolitics, apart from tariffs. So as that eases, we can't necessarily take for granted that it will ease. As we saw this past week, there can still be salvos, such as that around Canada, terminating negotiations, and then a retrenchment by Canada around its digital services tax. So just when we think we're looking at a period of less uncertainty, perhaps with tariffs, there is still the potential for negative surprise. But overall, as you mentioned, 90 days are coming up, and probably looking at either kicking that can down the road or announcing some kind of trade deal. And then when it comes to equity markets, I'd love to dig in a little bit to hear to some of the sectors that have done well. Last week, we talked about tech and financials doing well. Tech seems to always do well. Financials having had that tailwind of the suggestion of less regulation around the banks. I thought, and we've known about the defence stocks doing well, particularly in Europe, as NATO members committed to increase spending, and we know that was coming. I thought an interesting part that I didn't expect to see having done well, but actually has done surprisingly well, has actually been some of the clean energy stocks. Having suffered at the beginning of the Trump administration, they seem to have done well. If we look at clean energy relative to the mainstream S&P oil and gas. So I don't know whether you have any sort of either theory on that, or when you look at what's doing well within this stock market, what is doing well and why?
I probably broadly just to slightly focus on actually other parts of what the administration is doing. What the administration is doing is doing a whole raft of deregulation. You talked about financials, but the deregulation everywhere. Energy sector, for instance, across the board, not just clean energy. So I think this is a boost. And I think that CapEx will accelerate. So if the economy is on a reasonable keel, which is my core position, if the stock market is pushing forward, in other words, there's availability of capital, there was a big IPO just this week, for instance, so perhaps the IPO market can also pick up. Interest rates are trending down, or certainly not a problem. Then I think we have a lot of CapEx coming, and that CapEx could be across the board. It could be in clean energy. And I think, technology is changing the world very fast. We should come back to AI in a second. If you look what's happening in China, look at the way that the electric vehicle industry is expanding very, very dramatically. So, in the West, perhaps it's not being pushed quite as obviously by the government, but beneath the hood, new industries, new technologies are coming thick and fast, and that's pretty positive. And I think that is where I'm focusing. Just to focus a little bit on energy, one of the things that Scott Bessent did point out, one of their kind of strategies, supposedly to deal with fiscal deficit, who knows whether it's true or not, is to get growth up to 3% and to see an extra 3 million barrels a day of crude being produced in the US. So there will be a lot of incentives, a lot of encouragement for capex in the energy sector as a whole, not just clean energy. But why not clean energy? If it makes sense, if it's economic, and I think the technology, the cost now of solar panels, has come down, very, very dramatically. The return on some of those investments is now quite different. You don't need subsidies. You don't need regulation to force it. You just need to let markets do their thing. So that's all quite encouraging. So if you're looking at sectors that I might favor running into second half of this year into 26, I'm kind of less keen on financials. Interest rates are trending lower. So I think some of the positive benefit that financials have enjoyed, particularly the big banks in the last year with the net interest margin, I think that's been dissipated. They've had an incredible run. They were very cheap. They're less cheap now. I'd probably phase out of financials. Tech, one has to own it. I have no particular view on tech except probably be a neutral weighting. Where I probably look at is industrials, energy, anywhere, robotics, anywhere where capex is at play. It's obviously a key policy for the government. It was in the last administration as well. And I think that will continue. So I think there are, around the edges there are still a lot of opportunities to see significant growth.
Fantastic. And I think we could probably get you back for round two. There's certainly a lot to discuss, but just to quickly a whistle stop tour through some of our other topics today. The UK, I think we would be remiss if we don't have at least 1 minute on what we saw this week in the UK. We did have a PTSD for the Truss era at the end of 22, I believe, was when we had the sell-off in UK gilts, a loss of confidence in the fiscal discipline of the UK. I think we had that again during Prime Minister's question time, a perception that there was not support for the Chancellor, that some of the reforms would not get through, that again there was a sell-off in gilts, as we can see in this chart here. They subsequently did rally when it looked like there was more stability, at least on the horizon. And what was your first thought when you saw this unfold in the UK this week?
I'd probably put the UK in the basket of Western Europe. So, we're not in the EU, but essentially we're trading like an EU economy. I think all of Europe, it's frustrating as a taxpayer, to say the least. And the medium to long-term trajectory continues to be disappointing, on regulation, on tax, on levels of debt. France is probably in a worse position than the UK. No end in sight is probably the best way to put it. But is there going to be a Minsky moment? Ray Dalio's talking about it in the US, given the new big, beautiful bill and huge increases in federal deficit. Not in this cycle. At the moment, we have downward interest rates. The UK and the rest of Europe is essentially being bailed out by the Fed. As interest rates trend lower, then I think that everybody, perhaps with a more positive yield curve, can finance this appalling scenario. 3, 4, 5 years down the line, when we're in a different world and the Fed's raising rates, we could be in a different scenario. At the moment, I think the positive momentum in the global economy, the positive momentum in financial assets is going to bail dear old Rachel out.
And that I think gets me to we have seen that the dollar at its low 44-month low, that perhaps is the whether that's by design or part of policy. But I think this gets me to my last slide, which is around some of these juxtapositions, because Scott Bessent was on television speaking about the deficit, kind of minimizing the importance of this adding of 3 trillion plus to the deficit that would come from the big beautiful bill, because essentially his belief was that the US would grow its way out of this problem. And that's always been an argument that deficit interest payments don't matter if their growth is there. It's not been there in the UK. It's not been there in Europe. That's why deficits are a bigger problem, perhaps. I don't know what you think of that. But this gets back to a broader issue of, do the old rules still apply? Like, is the market right not to be focusing on deficits? We've looked at inverted yield curves, which haven't necessarily brought on recession. We have this weaker dollar right now, which stayed weak, even though the Fed is relatively higher. Still, the rates are higher in the US than elsewhere. Yes, the currency continues to weaken. So I suppose some of these economic rules of thumb are breaking down, just as policy continues to break some of the norms. Just to close us out.
American broken politics. Yeah, yeah. But let me take issue with that. I mean, the Republican Party's got a majority of 7 in the House of Representatives. Keir Starmer's got a majority of about 160. And yet they were able to pass a pretty controversial, all-encompassing, big, beautiful bill, including, by the way, increasing the debt ceiling by 5 trillion. That little charade that we used to go through every few months. So when there's a political will, there's an ideology that people buy into, it's surprisingly what can get done. So I wouldn't actually agree with you. American politics is broken. It's on a different path, which the voters seem to choose. That's up to them. European politics is in a muddle. European politicians, whether it's Merz, whether it's Macron, whether it's Starmer, they kind of don't know what to do. They're kind of stuck in this kind of centrist muddle. And that's why, even though parties get elected with majorities, they can't get anything done because they don't really know what to do. They don't have any ideology. Back to your sort of key question, do deficits matter? It's a bit like geopolitics. It only matters very, very occasionally. When it matters, it's kind of too late. So should we as investors be worrying about deficits and sort of hiding our money under the mattress? The answer is that one should worry about deficits because they are presaging a higher inflationary era. And that's where we are. We had a 40-year era from 1980, call it in broad brush terms, to 2020, where inflation was essentially muted interest rates. Global interest rates were on a long-term trend down. And now we're in a new era. We're in a new era of higher inflation. And I'm afraid the deficits essentially are one of the biggest reasons for that. That's where we are. In the higher inflation environment, you need to pay attention. You can't hide in cash or bonds because you will see your purchasing power destroyed. So whether you like it or not, you have to put together a diversified portfolio, including some non-dollar assets. People were, particularly US investors, were probably kind of blinkered into thinking it was only the US and that nowhere else could give them return. Well, hey, presto, 6 months later, we've seen the best performing markets in a dollar basis have been European markets. I think that continues for a while. I don't believe that US exceptionalism is over. I mean, there's plenty of people who are trying to call a top for that. I think it was just overpriced. And maybe that needs to be brought back to something like reality. Nvidia, one single stock was worth, multiple times the FTSE 100. That can't be right. There has to be some sort of sensible valuation. And we're seeing that being worked off. But a balanced, international portfolio with a heavy weight towards inflation protecting assets, that's where you should be.
Well, it is always a pleasure, Stephen. I've always take away a couple of sound bites, and that US exceptionalism not being over, but being overpriced, I think, is a great piece of food for thought to chew on. For some of us, for a long weekend. For the rest of us, it is going to be a regular weekend. But thank you so much for coming here for that rich panoply of subjects that we've cycled through. I think we definitely need to have a round 2 and probably a round 3. But thank you very much for sharing your insights here.
Flattery will get you everywhere. you very much. Have a lovely weekend.
Thank you. And thank you, everyone, for listening to today's Markets Happy Hour podcast.